Ever wonder how people invest in the stock market without having to pick individual stocks? Today, we're diving into two powerful tools for building wealth: ETFs and index funds. Whether you're a beginner or an experienced investor, these funds make investing easier and more accessible for everyone. So, what exactly are ETFs and index funds? You can think of ETFs, which stands for Exchange Traded Funds, and index funds as collections of stocks or bonds that you can buy all at once. So, instead of you having to research hundreds of companies, the ETF or index fund takes care of that for you by aligning its portfolio with the index it follows. For example, if you invest in an S&P 500 ETF or index fund, you're essentially buying tiny pieces of the 500 largest companies in the United States, giving you instant diversification without the hassle of picking individual stocks. Now that we know what ETFs and index funds are, let's talk about what sets them apart from actively managed funds like mutual funds. In actively managed funds, professional managers actively try to beat the market by selecting investments they believe will outperform. This often involves extensive research, analysis, and frequent trading, which can result in higher fees. For example, if you invest $100,000 in an actively managed mutual fund with an annual fee of 1%, you would pay $1,000 in fees each year, even if the fund performs poorly and you lose money. In contrast, ETFs and index funds are designed to follow a specific index, like S&P 500, and aim to match the performance of their target index, not beat it. This passive approach means lower management fees and less frequent trading, making them a cost-effective and straightforward option for investors. For example, if you invest $100,000 in an S&P 500 ETF with an annual fee of just 0.04%, you would pay only $40 in fees each year. Historically, many ETFs and index funds tend to outperform actively managed funds due to their lower costs. Understanding how index funds and ETFs are created can help you see why they operate differently. Let's break it down. Index funds are created when a group of investors pool their money together. This pooled capital is managed by a fund manager who invests it into a portfolio of assets that track a specific index, like the S&P 500. Here's the interesting part. When one of these investors decides to sell their shares in the index fund, they're essentially asking the fund manager to redeem their investment. The fund manager may need to sell some of the assets in the fund's portfolio to provide the investor with the cash they need. This process doesn't affect the value of the remaining investor's shares directly, but large redemptions can lead to costs, like transaction fees, which may slightly impact the fund's performance over time. ETFs, on the other hand, are created through a process called creation and redemption. Here's how it works. An ETF manager collaborates with a group of institutional investors, often called authorized participants. These participants buy a basket of securities that match the ETF's target index and transfer them to the ETF provider. In return, the provider issues ETF shares, which can then be sold to individual investors on the stock market. When you sell shares of an ETF, you're not redeeming them with the ETF manager like you would with an index fund. Instead, you're selling your shares to another investor in the market, just like trading stocks. This difference is what gives ETFs their intraday liquidity and makes them a favorite for active traders. Now, you might be wondering, what makes ETFs and index funds so popular? Let's go over some of their biggest benefits. Diversification. With a single investment, you're spreading your money across dozens, hundreds, or even thousands of companies. This reduces your risk because if one company doesn't perform well, others in the fund can help balance things out. Low fees. Since index funds and many ETFs aren't actively managed, they usually come with low fees. Low costs mean more of your money stays invested, helping it grow faster over time. Simplicity and convenience. ETFs and index funds offer a hands-off approach to investing. You don't need to constantly monitor individual stocks or worry about timing the market. These funds are designed to grow along with the market's overall performance. Long-term growth. Historically, the stock market has returned an average of 7 to 10% annually over the long term. By holding an ETF or index fund, you benefit from this steady growth, making them ideal for long-term financial goals. While ETFs and index funds are both great tools for investors looking for broad market exposure, they do have some differences that can affect your choice depending on your needs. ETFs trade on the stock market, meaning you can buy or sell them throughout the day, just like individual stocks. This flexibility can be great if you want to be more hands-on or take advantage of price fluctuations during the trading day. Index funds, on the other hand, are bought and sold only once per day at the closing price, making them a bit more straightforward for investors who don't want to worry about market timing. Most ETFs allow you to buy as little as one share, so you can start investing with a smaller amount of money. Index funds often have a minimum investment requirement, which can be $500, $1,000, or even more, depending on the fund provider. Generally, both ETFs and index funds come with low management fees compared to actively managed funds. But ETFs tend to have slightly lower fees since they're passively managed and don't require as many transactions. However, with ETFs, you may also pay a brokerage fee for each trade, whereas index funds might not have trading fees if you're investing directly through the fund provider. Another difference is how they handle dividends. With index funds, dividends are usually reinvested automatically, which can help you benefit from compounding. ETFs, on the other hand, typically pay out dividends as cash, although some brokers offer DRIP, dividend reinvestment plan, an option to reinvest them automatically. ETFs are generally more tax efficient because of how they're structured. When you sell shares of an ETF, you sell directly to another investor on the stock market, so there's no need for the fund to sell any of its underlying assets. This helps minimize capital gains distributions, which are taxable. Index funds, however, may need to sell assets more frequently to accommodate investor withdrawals, which can lead to taxable capital gains being distributed to all fund shareholders. This means you could end up owing taxes on gains even if you didn't sell your shares. That said, the impact of taxes depends on where you hold your investments. If they're in a tax-advantaged account like a TFSA or RRSP in Canada, or a 401k or IRA in the US, the tax differences might not matter as much. But in taxable accounts, ETFs often have the edge in terms of tax efficiency. Ultimately, both ETFs and index funds are designed to give you access to a broad range of stocks or bonds at a low cost, and the right choice for you depends on your investment style and goals. If you prefer flexibility and lower minimums, ETFs might be the way to go. But if you're looking for simplicity and automatic reinvestment, an index fund could be a great fit. If you're interested in getting started with ETFs or index funds, let's look at some of the most popular options that track the S&P 500. SPDR S&P 500 ETF is one of the oldest and most traded ETFs. It tracks the S&P 500 closely and is a favorite among investors for its liquidity. Vanguard S&P 500 ETF is managed by Vanguard, offers very low fees, and is a solid choice for cost-conscious investors. iShares Core S&P 500 ETF is another well-known option that offers low fees and solid performance, ideal for anyone looking to hold onto their investment long-term. While S&P 500-focused funds are among the most well-known, there's a whole world of ETFs and index funds targeting other segments of the market. These funds allow investors to diversify beyond large-cap U.S. companies, offering exposure to specific industries, geographies, or investment strategies. Vanguard Total Stock Market ETF provides exposure to the entire U.S. stock market, including small-cap and mid-cap companies that are not part of the S&P 500. This fund is a great choice for investors seeking comprehensive U.S. equity exposure. iShares MSCI Emerging Markets ETF focuses on emerging economies like China, India, and Brazil. While these markets come with higher risk, they also offer the potential for significant returns. Vanguard FTSE All-World ex-US Index Fund offers global diversification by tracking stocks from developed and emerging markets outside of the U.S. It's a solid choice for investors who want international exposure without U.S. companies. Schwab U.S. Dividend Equity ETF focuses on high-quality U.S. companies with strong dividend payouts. This fund is popular among income-focused investors who want consistent cash flow. So, how do you get started with ETFs or index funds? It's as easy as opening a brokerage account, searching for the fund's ticker symbol, and making a purchase. Remember, investing even a small amount consistently can add up significantly over time. Thanks for watching. If you found this video helpful, give it a thumbs up, and don't forget to subscribe for more investing tips and insights. Remember, building wealth doesn't have to be complicated. Stick with us, and we'll help you make the most of your investing journey.